Welcome back to the show. Today we're talking about the world's biggest balance sheet item, the national debt. Imagine waking up to find your credit card bill with 14 zeros on it. Countries don't borrow money because they're broke in the traditional sense. They do it to fuel growth, build bridges, funding research, or keeping the grid alive during a global crisis. It's a high stakes game of spend now, pay later, based on the bet that the country's future economy will be bigger and stronger than the current debt pile. But who actually holds the receipts? When we talk about the nation being in the red, we often imagine a shadowy group of bankers knocking on the door. But the reality is far from it and is pretty intertwined. From the pension fund that manages your retirements to holding a savings bond, and even the central bank that literally prints the currency itself. The web of creditors is a complex ecosystem of international investors and everyday citizens. Today, we're breaking down the world of macroeconomic, and being in debt might actually be a sign of stability rather than a looming sign of collapse. The US is currently staring down a fiscal milestone that is almost impossible to wrap your brain around. The national debt is approaching 39 trillion US dollars. To put that in perspective, if you spend a dollar every second, it would take you more than 1,000,000 years to pay off that debt. This isn't just a big number. It's accumulation of centuries of borrowing, starting with the $75 million the country owed right after the Revolutionary War. Back then, we borrowed from France and domestic investors just to keep the dream alive for a new nation. For the next century, the debt was a roller coaster, and it spiked during the Civil War, nearly hitting $3 billion. But then the government did something modern politicians would find to be a miracle. They paid off more than half of it during the next 4 decades. The real shift in the global IOU market happened in the 20th century, particularly during World War II, when the debt to GDP ratio soared above 100% for the first time. The US essentially put the entire global fight for democracy on a credit card. While the debt cooled off during the post-war boom, the 21st century has been a whole different story. Between the 2008 crisis and decades of military spending in the Middle East, and the massive stimulus packages required to keep the economy afloat during COVID-19, the debt has more than doubled in the last 15 years alone. Today, we aren't just borrowing for emergencies. We're borrowing to cover the interest that we've already owed, creating a compound cycle where interest payments alone are starting to rival the entire defense budget. When you ask who's actually holding this $39 trillion worth of debts receivable, the answer is pretty close to home. Roughly 80% of the debt is held by the public, but the public can be misleading. The largest slice belongs to the Federal Reserve, which buys government bonds to influence the economy. Behind them are massive pension funds and mutual funds, meaning that if you have a 401k or a retirement plan, you are likely one of the people who the US government owes money to. Then there are intergovernmental debt, which is about $7.6 trillion, which is basically the government borrowing from its left pocket to pay its right pocket, effectively taking surplus from programs like Social Security and Medicare and replacing them with IOUs. On the international stage, the cast of characters have shifted over the last decade. For years, China was a major buyer of US treasuries, but have now been steadily offloading their holdings, now sitting only at around $700 billion. However, stepping onto the top spot is Japan, currently holding over $1.1 trillion of US debt, viewing the American dollar as a safe harbor in the stormy global economy. The United Kingdom and major European financial hubs follow closely behind. While people often worry that foreign countries could call in the debt and crash the economy, the reality is that these nations are buying US debt because it's basically the bedrock for the entire global financial system. If they try to crash the US market, they're essentially burning their own savings. Expanding from the US, the entire planet is basically in a financial landscape that is just borrowing. A global debt mountain that reaches a staggering $348 trillion that was reported at the end of 2025. This isn't just a collection of government IOUs. It consists of public debt, corporate debt, and household liabilities. While you might expect the most owed is by the government, the largest part is actually belongs to the private sector, businesses and families with mortgages and credit lines that keep the wheels of the industries turning. However, there is a structural shift that is going on right now. Since the pandemic, private debt has been shrinking as a percentage of the global economy, while government debt has ballooned nearly 93% of the world's GDP. We are essentially watching a great handover, where the risk once held by banks and homeowners are being absorbed by the nation's treasuries to keep the global engine from breaking. The way this debt is structured depends entirely on whether the country is a rule maker or a rule taker in the global economy. Developed nations like Japan or the UK structure the vast majority of their debt as domestic bonds, meaning they are primarily borrowing from their own citizens, pension funds, and insurance company in their own currency. This creates a closed loop system where interest paid by the government goes back to the pockets of its own people, acting more like a mandatory savings account than a traditional loan. In contrast, emerging markets often look outwards, structuring their debt as external loans from official creditors like the IMF, which stands for International Monetary Fund, and the World Bank, or through bilateral agreements with other nations. For centuries, the debt is often denominated in US dollars rather than their own currency, which creates a dangerous original sin in economics. If your local currency loses value, their debt effectively grows even if they haven't borrowed another penny. Ultimately, the most mind-bending part of the global debt structure is the realization that the world doesn't actually owe money to any aliens on Mars. It just owes money to itself. If you add up every single dollar of debt on Earth and subtract it by every single creditor, the grand total is zero. We're living in a giant web of promises. This circularity is what allows the systems to function. As long as investors believe that tomorrow's economy will be more productive than today's, the global IOU can keep growing indefinitely. It's the literal infrastructure of the modern world. Without these $348 trillion in promises, the global financial system would just slow down or stop completely, because the current world is one where a person's debt is another person's asset. For nearly 15 years, the global debt market operated under one kind of artificial life support, known as quantitative easing. During the era of central banks led by the US Federal Reserve, which acted as the buyer of last resort, they were effectively looking to bargain or for a high return. Their goal was purely policy driven, to keep interest rates low by purchasing trillions in government bonds. This made them price insensitive to creditors. They didn't care if the country's deficit was ballooning or if the yield was pathetic. They bought it anyways. However, that era has effectively ended. The Fed and the European Central Bank have spent the last few years aggressively shrinking their balance sheets, stepping back from the markets and leaving a massive $1 trillion hole for everyone else to fill, and basically enters a price-sensitive sharks. The new class of creditors, consistent of hedge funds, private equity firms, and high net worth individuals, who are not only buying bonds out of the sense of a national duty or monetary policy, they are buying for one reason: yield. Unlike the central banks, these players are hyper aware of the risk. If they sense a government fiscal path is unsustainable, or if inflation begins to creep back up, passing the 3% mark we've been seeing in basically these past few years, they don't just sit and hold. They demand higher interest rate to compensate for the risk, or they dump their entire holdings. This shift has essentially brought back bond vigilantes, a term for investors who vote on countries' policies by selling bonds, effectively forcing interest rates higher and pushing government overspending. The involvement of hedge funds, in particular, has added a layer of leverage volatility that the market hasn't really dealt with in the more recent decades. Because of these funds often use borrowed money to buy government debt, frequently through the repo market. These positions are incredibly sensitive to sudden shifts. If the market moves against them by even a fraction of a percentage, they may be forced to sell off billions in bonds almost instantly to cover their losses. We saw the shadow of this risk earlier in 2026 when concerns over geopolitical fragmentation caused a brief sharp spike in yields. When the primary creditors are sharks looking for a quick exit rather than a long-term capital bank partner, the global economy became more speculative to flash crashes, where the government debt suddenly becomes volatile. Furthermore, we're seeing a democratization of this debt which sets in its own anxieties. With the Fed stepping back, private households and mutual funds have become massive buyers of US Treasuries, lured by the basically high yields in the past few years that they've ever seen. While this sounds stable on the surface, individual investors are notoriously not as reliable. Because unlike central bank that can hold a bond towards maturity regardless of the chaos in the market, a million individual retirees might panic and sell their bonds the moment they see a scary headline on the news like the debt ceiling or political stuff in Washington. This means that the US government is increasingly at the mercy of the daily speculative person and group of creditors who can move trillions of dollars just a few taps in their smartphone. To understand the true nature of a nation's debt, we have to stop thinking about it as a single mountain of money and start seeing it as a vast interconnected system of IOUs. At the most basic level, the who of the global debt is split into two categories, internal and external. Internal debt is essentially a country borrowing from its own future, money owed to its own citizens, domestic banks, and pension funds. When you buy a government bond for your retirement account, you aren't just an investor, you're a government creditor. In contrast, government debt is owed to foreign entities like international banks or other governments. For superpowers like the US, the majority of its debt is actually held internally. This creates a strange paradox. If the government were to suddenly pay off all its debt, it would essentially be liquidating the safest part of its own citizens' retirement portfolio. One of the most misunderstood concerns of the ecosystem is intergovernment debt, which is currently over $7.5 trillion of the total US debt. This is often described as government borrowing from its left to its right pocket. The most famous example is Social Security Fund. For decades, Social Security collected more in payroll taxes than it paid out in benefits. Rather than letting its extra cash sit in a vault, the Treasury borrowed it from the government general funds, replacing the cash with special issued bonds. Today, Social Security funds hold roughly $2.7 trillion in these special bonds. While some critics call this an accounting trick, it's technically a legal obligation. The government is required to pay back the money with interest, making the retirement of every American citizen a direct stake in the nation's ability to manage its own debt. For developing nations, the creditors often take a multilateral form through institutions like the IMF and the World Bank. These organizations act as last resorts for these countries that have been frozen out of private markets due to economic instability or crisis. Unlike a commercial bank that just wants its interests, these multilateral leaders often have strict attachments and conditions to their money, demanding a country overhaul its tax system or cut spending in exchange for a lifeline. This creates a different kind of debt relationship, one where the creditor isn't just an investor, but a temporary economic supervisor. For many nations in the global south, these debts are pretty critical because they represent the only barrier between functional government services and a total financial collapse. If we were to look at the global debt map, the big three, the US, China, and Japan, would dominate the landscape. But for different reasons. The US sits atop of a $39 trillion, but because the dollar is the world's reserve currency, the debt essentially functions as the world's primary savings account. Central banks around the world hold US treasuries as their safest assets. Japan, meanwhile, has a debt to GDP ratio that dwarfs everyone else, over 260%. Yet it remains stable because most of its debt is intentionally held by Japanese citizens. China occupies the middle ground with a rapid growing debt pile of over 18 trillion that is heavily tied to infrastructure and local government sharks. Well, you stack these three together and you realize the combined $70 trillion in debt isn't just a liability, it's a source of global liquidity. In a world where everyone is looking for a safe place to hold their cash, these nations' debt are ironically the very thing keeping the global financial system from freezing up. The ultimate reality of this $348 trillion of global debt is that we are no longer living in an era of contained national budgets. We're living in an age of basically perpetual debt. From the high stakes demand of price sensitive sharks to the internal shifts of trillions of dollars from social security, the mechanisms of money have basically shifted. We've moved past the point where debt is temporary pool used for emergencies and has become the literal blood for the global economy, a system that requires consistent, massive borrowing to maintain everything. The shell game between the Treasury's left and right pocket was just a functional bridge for decades. But as the silver tsunami of retirees begins to cash in on their retirement, the bridge becomes harder to maintain and more expensive than the public really knows. Whether the debt is ever actually paid off, it probably won't happen because it won't make any sense. The real question is, how long will the world's creditors continue to believe the promise of the future? We all have patience. The collective bet that tomorrow's growth will always outpace yesterday's borrowing is getting harder and harder to believe. If that belief holds, the system continues with this delicate balance. If it fails, the global debt becomes a weight that no single nation is strong enough to carry. And in the end, national debt isn't just a number on the screen. It's the ultimate number to measure the confidence of one nation from another. Thank you for listening.